Welcome to Iron Financial, the only place where we forge stronger portfolios by cutting right through market weakness. I'm your lead analyst, Bob, and with me, as always, is our market skeptic, Chris. Today, we are strapping on the tool belts and conducting a full structural analysis of a company called Amtech Systems. Now, after the market closed on February 5th, this stock didn't just fall, it completely cratered. It was a demolition event, plain and simple. So we're going to put on our hard hats, we're going to unroll the blueprints, and we are going to inspect this thing from the concrete foundation all the way up to the rafters. Our mission today is simple: to determine if the market's demolition crew went way too far or if this building was condemned for a very, very good reason. Let's get to work. Okay, let's just get right into the damage report. Just look at this number, -32%. I mean, this isn't some minor correction, this isn't a dip, this is a gut punch to anyone holding this stock. You know, when a company loses nearly a third of its entire value in what feels like the span of an hour, it's a seismic event. It is a signal flare of pure, unadulterated panic cutting through the night sky. And it tells you one thing: there is a massive, violent disconnect between what Wall Street expected and the reality that the company just delivered on a single sheet of paper. Our job today is to dig through all of that rubble and find out what that reality actually is. And here it is, this headline from the FinTool AI agent. Well, it's basically the blueprint for the entire conflict, isn't it? It perfectly captures the chaos. It captures the core contradiction that caused this massive sell-off. On one side, you have the two magic words that every single investor wants to see in 2026, AI momentum. That's the dream, right? But on the other side, you have the absolute nightmare, an EPS miss of almost 60%. It is a brutal head-on collision between a powerful, forward-looking growth story and a bottom-line failure that is happening right here, right now. The market saw this headline, and let me tell you, it didn't think twice. It just slammed the sell button with extreme prejudice. Right, so before we start swinging hammers, we need a plan of attack. This isn't just about staring at a giant crater in a stock chart. We're conducting a full structural inspection. First, we're going to walk the perimeter of the demolition site. We'll survey the carnage, sizing up the full extent of this 30+% collapse. Then, we're going to deconstruct that headline mess. We're putting that earnings report right under the microscope. After that, Bob's going to take us down to the bedrock, down to the balance sheet, to see if the foundation is actually solid or if it's just made of sand. From there, we'll look at the growth engine, that AI and packaging story that was supposed to be the rocket fuel. But look, a real inspection means looking for the hidden cracks and the headwinds that the bulls might be ignoring. And finally, after weighing all the evidence, we'll deliver our verdict. Is this a buying opportunity in a structurally sound company, or is it just a trap door waiting for unsuspecting investors? All right, let's get into these specifics of the collapse. We have to measure the impact before we can even begin to diagnose the cause. And the numbers here, they tell a story of a market that was perfectly content one moment and then just utterly, completely terrified the next. The stock market is, at its core, a machine for pricing in new information, and on February 5th, that machine went into violent, brutal overdrive.
So Bob, just look at this table. It really lays out the timeline of the disaster, doesn't it? The stock closes the regular session at $15.87, actually up a little on the day. Everything appears calm, right? Then the earnings report drops, and in the after-hour session, it just plummets to a low of $10.79. That's a $5 drop on a $15 stock. I mean, what I want to know is why the sheer brutality? Let's not forget the context here. This stock had already rallied over 400% from its 52-week low of just $3.20. Were expectations so stratospheric, so completely detached from reality, that anything less than absolute perfection was guaranteed to cause a catastrophe? It really feels like the market priced this company for an A+ report card, and the company walked in and turned in a C-.
That's exactly the right question, Chris. Expectations. Expectations are the real killer in this story. The market had built a skyscraper of hope on top of this stock, and the foundation simply wasn't ready to bear that much weight. So now, let's perform the autopsy. We are going to examine the scene of the crime, the Q1 2026 earnings report. This is where we find the weapon that murdered 30% of the company's market cap. And believe me, the numbers do not lie. And here it is. This right here is the smoking gun. Take a look at the top line, revenue. $19 million reported versus $19 million expected. It was perfectly in line. So the business generated the sales everyone thought it would. The top line was not the problem. But then you look at the bottom line, the earnings per share, or EPS. This is the company's profit divided by the number of shares. The normalized EPS came in at just 3 cents.
Wall Street's consensus was for 7 cents. That is a 57% miss. Now, for a high-flying growth stock, that's not just a miss, that's a betrayal. The market sold off because the company sold an AI growth story but just couldn't deliver the profits to back it up.
Okay, but hold on, Bob. I'm looking beyond just the miss against the estimate here. Let's compare this quarter to the same quarter last year. Revenue is down 22%. It fell from over 24 million to just 19 million. Now, management can use phrases like product line rationalization all they want, but a 22% drop in revenue year over year, that is a serious crack in the facade. So, was the EPS miss really the only problem here, or was it just the most obvious flaw in a structure that was already showing signs of some pretty significant weakness? A business that's shrinking by over a fifth is just not a healthy business on the surface. That's a very fair point, Chris. A revenue decline is never pretty, and it's definitely a crack we have to inspect. But headline numbers and year-over-year comparisons, they just don't tell the whole story. They're the paint job, you know? They're the drywall. To truly understand a company's durability, you have to ignore the surface, and you have to inspect the financial bedrock. You have to go down to the balance sheet. This is where a company's real strength lies, and frankly, this is where the bear case really starts to crumble. Let's start with pillar number 1 of Amtech's financial strength, cash. They ended the quarter with $22.1 million. In a volatile market, in any market, cash is king. It's the ultimate shock absorber. This isn't some company living paycheck to paycheck. They have a war chest. Now for pillar number 2, and honestly, it's just as important, zero. That is the amount of debt on their balance sheet. Just think about that for a second. No interest payments eating away at your profits. No restrictive covenants from lenders telling you what you can and can't do. Complete and total financial freedom. A fortress balance sheet starts with zero debt. And the third pillar is all about consistency. 9. That represents 9 consecutive quarters. That's over 2 years of positive operating cash flow. This isn't some one-time accounting trick or a fluke. It's sustained, consistent proof that the core business is fundamentally healthy and generates more cash than it consumes. That, my friends, is a well-oiled machine.
And this just brilliantly illustrates the point. Let's put it all together. A year ago, in Q1 2025, Amtech had $13.2 million in cash. Today, they have $22.1 million. That is a 67% increase in their cash pile in just 12 months, all while carrying zero debt and consistently generating cash from their operations. So while the market is panicking about a 22% drop in revenue, the company's actual financial foundation has gotten 67% stronger. They are not getting weaker. They are building financial muscle.
I'll grant you that, Bob. A fortress balance sheet is impressive. You really can't argue with $22 million in cash and no debt. It means they're not going out of business tomorrow, that's for sure. But a strong foundation is pretty useless if you're not building anything on top of it. A fortress with no one inside is just a museum. Investors didn't bid the stock up 400% because of its cash position. They bought it for growth. So the critical question remains, where is that future growth actually going to come from to justify a higher stock price? What's the blueprint for the next floor? The growth, Chris, is coming from the single most powerful trend in the market today, artificial intelligence. Now, what's really interesting here is the composition of their core business, the thermal processing solutions segment. AI-related products now make up 35% of that segment's revenue. And get this, that's up from 30% just last quarter. So not only is it a significant chunk of the business, it's the fastest growing part. They are directly supplying the picks and shovels, the essential equipment for the AI infrastructure gold rush. This isn't a hope, it's not a dream, it's happening right now in their order book. And it gets even better. Beyond the current AI demand, they're building the next growth engine with something called panel-level packaging. Now, simply put, this is a new technology for making chip packaging more efficient and more cost-effective, which is a critical bottleneck in the semiconductor industry. And I want you to read this quote from the CEO, Bob Daigle. He calls it the future of advanced packaging. He says they've already received initial orders from multiple industry leaders, which he calls good validation about future demand. This isn't just some R&D project in a lab, it's a commercial reality with paying customers lining up. That all sounds great, Bob. It really is a compelling story. But a story doesn't pay the bills today. I went through the earnings call transcript, and while the CEO is optimistic, he also said, and I'm quoting here, "You're looking at probably 2027 before we would see any meaningful demand from that next generation equipment." 2027. Bob, that's a long time to wait for a payoff.
That's practically another lifetime in this market. So they have the tech, they have some initial orders, but the real revenue ramp is still years away. Can investors really afford to be that patient when the current business is showing double-digit year-over-year declines? The timeline here is a major, major concern for me.
That is a very valid point, Chris. And you can't conduct a proper inspection without looking for the flaws. The growth story is compelling, and yes, the balance sheet is a fortress, but a full analysis requires us to examine the negatives with the exact same intensity. We have to go back to that ugly EPS number and the headwinds facing the business. It's time to look for those hidden cracks in the structure. Exactly. So let's start with the elephant in the room that absolutely crushed the earnings per share. This question right here is the one that every single analyst was asking after the report. How on earth does a company end up with an 83% effective tax rate? I mean, that's not just high, it's absurd. It feels like a catastrophic error, but it's not. So, Bob, walk us through this. What in the world happened here? Because this is the detail that blew up the bottom line and triggered the entire sell-off. Okay, deep breath. This is one of those times where you have to be an accountant to be an analyst. The culprit is something called a valuation allowance. Here's the simple explanation. Amtech's U.S. operations are currently running at a loss. Normally, those losses would generate tax credits. They're called deferred tax assets that you could use to offset future profits. However, under accounting rules, if it's more likely than not that you won't generate enough future profit to actually use those assets, you have to create a reserve against them. So what happened? Their U.S. losses provided zero tax benefit this quarter. Meanwhile, their profitable foreign operations were still taxed normally. The end result is a tiny pre-tax income getting hit with a normal-sized foreign tax bill, which creates that bizarrely high 83% rate. But the crucial point is this. This is a non-cash charge. It's an accounting complexity, not a fundamental operational flaw that's draining real cash from the business.
Okay, that explains the tax hit, but it doesn't just erase all the other problems. A full inspection has to be honest about all the structural issues. So let's just list them out. First, there's continued weak demand in their PR Hoffman division, which serves the older, mature semiconductor nodes. That's a cyclical drag. Second, management themselves are calling 2026 an investment year for another one of their segments, which, is Wall Street code for don't expect any profits from here anytime soon. Third, they are increasing spending on R&D and SG&A to fund that next-gen tech. That means higher costs today for potential payoff tomorrow. Fourth, as we discussed, investor expectations were just sky high after a 400% run. Fifth, there's always customer concentration risk when you're so tied to a few big players in the AI space. And finally, as I already mentioned, the real payoff from their most exciting new technology isn't expected until 2027. These are not trivial concerns, Bob.
Absolutely not. They are significant headwinds. And that's exactly why we do this. We weigh the evidence on both sides of the ledger. We've inspected the damage, we've analyzed the earnings miss, we've tested the foundation, examined the growth engine, and we have identified the hidden cracks. Now it is time to put it all together. It's time to weigh all the evidence and deliver the final verdict from Iron Financial. This is the final blueprint. So let's lay it all out side by side. The bull case is built on a rock-solid, debt-free balance sheet with over $22 million in cash. It's fueled by a growing mix of high-demand AI revenue, which is driving a positive 1.1 book-to-bill ratio. That means new orders are coming in faster than they can even ship the product. The bulls feed 9 straight quarters of positive operating cash flow and a massive new opportunity in panel-level packaging. The bear case, however, points to that jarring EPS miss, driven by that bizarre tax situation and increased spending. The bears are worried about the cyclical weakness in their older business, that 22% year-over-year revenue drop, and the simple fact that the stock had gotten way, way ahead of itself. And critically, they are very skeptical about having to wait until 2027 for the next big growth driver to finally kick in. After inspecting every single beam and rivet of this company, our verdict at Iron Financial is clear. The headline EPS miss was a broken window. It was ugly, it was distracting, and it was a complex accounting issue that completely shattered investor confidence. But the market panicked, and it reacted as if the entire steel frame of the building had failed. They confused a superficial flaw for a foundational crisis. The core structure, a debt-free balance sheet, strong and consistent operating cash flow, and direct growing exposure to the AI build-out, that structure remains incredibly strong. The market threw out the steel frame because of a broken window, and for investors who can see past the shattered glass, that is where opportunity is forged.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.